Okay, so good morning, everyone. Welcome to the macro snapshot. We are Wednesday, February the 5th, 2025, recording this about 7 o'clock in the morning, 7:15. Okay, guys, so just to wrap up a little bit, let's see what's going on. We had our friend Trump yesterday. What do we have from Trump? I'm not going to get into his comments on Gaza and the politics of all that, but just in terms of the tariffs and the markets, there had been scheduled apparently a call yesterday with President Xi Jinping of China. That didn't take place. And, later yesterday, we saw that Trump said that he would talk to him at the appropriate moment. He didn't mind that China had put retaliatory tariffs in place. So now we have 10% across the board on Chinese imports going into the US, and the Chinese on their side have, done some retaliatory tariffs in terms of energy imports and farm equipment. And what we also saw is that they've opened some probes, some investigative cases into Apple, I think Intel, and I think Amazon, Google as well, a couple of the big American tech companies. It's a little bit vague why, but probably just to send a warning shot to the US about doing business with them. So all that to say that my takeaway from that is that Trump had very quick sort of victories or transactional victories with Canada and Mexico. But I think China is playing a little bit tougher. And maybe Trump was hoping for a quick phone call and was hoping to then sort of declare victory and say that, China had, conceded X, Y, Z. But that hasn't been the case. And so the market didn't particularly like that. And I think behind the scenes, that's probably, it's going to be a lot tougher to sort of force China to make concessions, basically. And in fact, we've already seen that China has retaliated and seems to be playing the longer game. So interesting. Other little thing which I saw this morning, which got my attention, is that the numbers of global treasury flows, the US Treasury market has come out. And it seems that after the US election, so the US election won by Donald Trump, there was very, very significant selling of US Treasuries by China and some other sort of hostile nations. So not to get into a conspiracy theory, but it's interesting. Who knows? Maybe that was a warning shot to Trump, to the Trump administration, essentially saying from countries like China, saying, "Hey, we hold a lot of your treasuries. Don't push us too much because we could cause some severe disruptions to your treasury market." Again, don't want to read too much into that, but quite interesting. Very, very heavy selling pressure at an institutional sort of central bank level after the US elections. Okay, in terms of what's coming up, we do have the quarterly refunding announcement. We had the first part of that on Monday afternoon at 3 p.m. No big surprises there. What we have this morning is going to be the composition. So without getting too much into all of the details, essentially Janet Yellen, and again, we'll go back here to November of 2023, which is here, down here. And you can see this is really the beginning of the huge rally in a certain sense of the S&P 500 and the equities. And basically at that point, at the QRA on November the 1st, 2023, Janet Yellen decided to issue a much smaller percentage of long-term bonds, what we call coupons, and push a lot of the issuance into the front of the curve in the form of, very short-term bills and whatnot. The point of all that was that sort of took pressure off the long end of the curve, pulling down yields, which of course is a bit of a risk-on kind of sentiment, plenty of liquidity, and we see the results of a very strong stock market, amongst other causes for that, of course. The point is that today, and that's been the situation under Janet Yellen in the Biden administration. Of course, now we have Scott Bessent. He's now taken over the Treasury under Trump, of course, and he's on record as saying that he disagrees with that and that the normal sort of tenors, the mixture of short and long-term bonds should be reintroduced and rebalanced. So at some point, it seems probable that we'll have longer, average weighted maturity. So more 10-year bonds issued and more 30-year bonds issued, which should put upward pressure on those yields, should steepen the curve, and in theory could be a little bit of a headwind, a little bit negative for the equity markets. It's as if it's not introduced in a very subtle way. Now we've obviously had some of the tariff news. So what we're really looking out for today is the coupon sizes, and a lot of people are saying that the market is not really expecting extra coupons at this point, like in this particular announcement. But what we could see is a change of language somewhere in the statement signaling that's the Treasury's intention is to start issuing slowly a little higher percentage of long-term bonds. And where we might see this, it's part of the statement here. You see that this has been the case for many, many quarters. They've got, you see here in the middle here, based on current projected borrowing needs. This is an important thing. Treasury does not anticipate needing to increase nominal coupon or FNR auction sizes for at least the next several quarters. So this is the one which we need to be looking at 8:30 this morning. If this changes and it says that, hey, the Treasury is not doing anything this time, but it may start to increase the nominal coupons or auction sizes sometime in the next quarter or two or three, the market, I think, will take that. I mean, I think that's a negative in the sense that we could get a steepening of the curve. We could get a little extra risk premium on the long-term yields, which could go up, and that could put equities under pressure. So that's really what we need to be looking at. And of course, if they actually, I mean, what are some of the scenarios? Very, very low probability is that they actually reduce the coupon sizes, so they reduce the number of bond auctions. That would be a very, very positive thing for risk. So the long end of the curve would probably, go much higher in price. The equities should probably love that. If they keep it flat and unchanged, we have to look at the wording. If they don't change this wording, that also, I believe, would be positive for equities and positive for the bond market, the long-term bonds. What I think they may do, and this is sort of maybe a 50-50, is to leave the coupon sizing unchanged, but just tweak the wording as we see in this statement here, and basically saying to the market, hey, at some point in the next 3 or 6 months, we're going to start to ramp up the bond issuance, which again could be negative for the long end of the curve. We could get a bear steepening of the curve, which could put equities under pressure. So that's kind of an important one. The other interesting thing to look out for today, we have a little bit of data at 8:15. Coming up relatively soon. We have the ADP employment numbers, which is the private payrolls company, expected to come in at 150,000, a bit more than last time, which was 122. That is not particularly well correlated, hasn't been particularly well correlated with the non-farm payrolls since the days of COVID. It's getting a little bit better because they changed the methodology. Let's just say it's an input. It's interesting. Let's see where we're going. But there's no real reason to expect the US employment situation to have deteriorated. Everything in the recent data in employment points to a very strong labor market. What possibly could be more market moving is at 10 o'clock, we have the ISM services. If you guys remember, we had the manufacturing a few days ago, which was relatively stable, around about 50. What we'll be looking out here for is the employment component, new orders signaling future, estimations of future activity. And of course, the prices paid is going to be super important just because we know that the Fed at the moment, in terms of their mandate, is very, very focused on the inflation. Lady Gray this morning. Right, so that's definitely what we need to be looking out for today. Of course, we're potentially having Trump headlines and all of that. Just in terms of a few other things, we had overnight, we had a couple of earnings, which were sort of not necessarily terrible or horrible, but the market at the moment, as we all know, in terms of tech companies, is very, very focused on data centers and capex, capital expenditure, and this whole idea of whether DeepSeek is causing a reevaluation of the need to spend so much money, capital expenditure on AI and AI infrastructure with NVIDIA and these kind of companies. And basically, yesterday afternoon at 4 o'clock, we had the Google Alphabet earnings. The actual earnings, the revenue was pretty good, but where the market was disappointed, and we see that Google this morning is down about, I think it's about 6 or 7% pre-market, was that the capital expenditure was much higher than expected. I think the number was up to 75 billion projected in 2025. So really at the top end of the estimates, and a little bit more than analysts had been expecting. So the narrative here is that with DeepSeek, should these companies like sort of Microsoft or like Google, these companies be spending so much money on NVIDIA's products and capex in general, and that's pushing down the equity price, and the market didn't like that. And you can see here that the stocks have come off, especially the Nasdaq. You see here Nasdaq down 82 basis points. whereas the Russell actually up, and you see ES down 45 basis points. So really Nasdaq underperforming pretty badly. The other thing with Alphabet was that their the cloud services, the growth slowed a little bit. We also had the earnings from AMD, the chip maker. Again, their earnings and revenue was pretty good, and their forecasts were pretty solid. But the problem was that the data sales, the data center, the sales forecast for their data centers was lower than expected. So that's what brought down AMD's shares as well. So we've got AMD and Google down. And again, this whole sort of questioning of the whole space, and I think that's really the symbolic narrative, is simply that, some of these huge tech companies, are sort of overspending essentially on capital expenditure, on CapEx in the AI space. They're not monetizing AI quickly enough. They're not getting a return on investment quickly enough. So that's interesting. On the other hand, just a small point to think about is that, if these huge behemoths, these huge tech behemoths like Microsoft's and your Google's and your Meta's continue to spend enormous amounts of money on AI infrastructure, could one say that maybe Nvidia, which, as we all know, has had a pretty horrible time of it lately. Let's see if I get the right ticker here. Nvidia, which has been beaten down quite a lot. We saw it gap down here. Could that sort of have a little bit of a pushback? We shall see. Maybe it's early days. It's still a very, very weak chart, but we shall see. Just in terms of the ES as well, I just want to have a quick look. If you look on the 1 hour chart here, it's struggling, to be honest, because what we can see here is that this is the gap down also on the tariff. So the stocks at the moment, they've got potential tariffs, potentially higher longer term interest rates if we get the QRA, and then we have a potential overspending on CapEx and an underperformance in return from AI. And we see this gap here. This was the tariff gap. Now it filled the gap here at about 6,065. Okay, great. So that's a positive first thing. Rejected there, then rejected there. So this is getting pretty critical because at this point, if we just put this on this short-term impulse here, essentially what we want to see, what the bulls need to see is some kind of, so we had the fib retracement, which is the gap fill, which corresponds also to about the 68% fib retracement. Bit of a failure. Okay, no problem. Let's try again. A problem. So this is getting critical here because really at this point, until and unless it can break through this gap at about 6,070 and break above that, maybe test local sort of highs up here. You got to say that still the market is still trading a little on the heavy side. So that's going to be a pretty critical one to be looking out for. In fact, I might keep that up here. Personally, I was hoping that this would sort of pop through, but we are getting a lot of uncertainty from Trump on tariffs, and the China situation with tariffs doesn't look as though it's having a quick resolution. And of course, we're getting some weak earnings, so that's what's happening in the stocks. Other interesting point overnight, we got out of Japan. If we just look at the, I'll put on the futures, the Japanese futures here, so the FX, we see a very weak US dollar. And that's no surprise. I mean, it's just selling off after the resolution in the tariff, at least in the sort of context of Mexico and Canada, having a little bit of a risk-on kind of moment in the currency. So we're seeing things like the dollar index here coming back. Again, I think it's going to be pretty interesting whether it can go below this level back into this long-term trade range here. I think there could be some support here at 107-ish. What do we got here? 106.9, around about here. I think that would be worth, quite possibly the US dollar there could find some support. But the yen breaking out was if you see here, it was just a consolidating, having a nice sort of breakout candle. That's because we got overnight some very strong wage data. So this whole idea that inflation is picking up in a solid way in Japan, and probably more to the point, I think it was the deputy governor of the BOJ indicated that 2 hikes, not one, but 2 further hikes in 2023 may be a possibility. So the Japanese yen here are benefiting from a slightly hawkish BOJ, increased inflation, also a bit of a safe haven status, why not? And it's been beaten down quite a lot. So it looks as though the Japanese yen, possibly at least can test up here on the futures up to, what is that, 66,315 up there. So another sort of 0.5% or so. That's an interesting one. Other things looking at is oil, which I've got to say, disappointing price action. And a lot of turbulence coming out of Trump's comments. So if we look here, just on the front contract here, what we can see here, guys, this is disappointing price action because it tested up here. It came back to the fib level. which was also horizontal support here. Took a shot at it, had a bit of a rally, and now it's breaking down below there. Now, did pop a little bit yesterday just because Trump, again, very, very difficult, very, very choppy. He signed a memorandum, a presidential memorandum basically saying maximum pressure on the Iranian regime, including sanctions. So the market took a positive from that in terms of price for oil and popped up, 150 ticks, basically with this idea that the US might reinforce and even increase sanctions on oil, and Trump himself saying that they reserve the right to stop, quote unquote, Iran selling oil. But then subsequently at a press conference, he said, he's a great friend of the Iranian people, and he didn't really want to hurt Iran, and he really loved talking and let's negotiate and make a deal. So of course the oil market, sort of confused and reversing on that. So at this point, the price action in oil does look heavy. It kind of failed to break above this little fib retracement here at 75.19. It's retested this pretty key level here all along here. You see this level in the front contract of, let's call it around about $72, 72.20. Again, we had the little bounce yesterday on the Iran, but you see this morning under pressure, and probably also under pressure because just looking here at the API numbers, we had API yesterday afternoon, which was actually fairly poor, quite bad numbers. So we had a build of 5 million barrels in crude, which is not at all great. In gasoline, we had 5.4 million barrels as a build. What else do we have? Distillates. Okay, well, distillates was a draw, a pretty good draw. But still, overall, the crude and the gasoline numbers not good. A surprise build there and a fairly significant build. So I think we have the EIA, the Department of Energy. We have the Department of Energy sort of numbers this morning, the official inventories. If that confirms the build, you've got to say that oil could be under a bit more pressure here, absent any sort of crazy Trump headlines about Iran or sanctions or making Gaza into the Riviera of the East. We'll see about that one. And we could see oil, maybe even pushing down to test this recent low at 70.70. And to be honest, once it gets going, oil can go, $3, $4, $5, $6 pretty fast. So that could actually push all the way back down and test these levels all the way down here at 67. We shall see. Other thing, just in the commodity space, not a huge amount going on, but we do see a bit of weakness in the US dollar, as I've seen, and we see that gold absolutely, going almost parabolic at this point. Gold, new highs. This is the spot market. You also see, though, in the COMEX futures, GC1, I don't know. This is new highs. So at this point, you have to start sort of doing fib extensions and sort of trying to see where this could go. Let's some kind of measured move. But you see, for example, on this fib extension, it's already blown above that. If we do like a further fib extension, you could start measuring out measured moves, something maybe like this, and you see that we're getting into some pretty overextended measured moves. And if I look at the technicals here, and I've just got here a bunch of sort of stochastics and indicators, which I like to look at. You can see here that on the daily Bollinger Bands, well, we're technically still, as I was saying to you a couple of days ago, I thought, the yellow, signaling the potential for a reversal. We're extremely overbought. You see here, the MACD is very, very high, really powering on, but you can see we're in very overbought territory, extremely elevated levels. But to be honest, we're still underneath the Bollinger Bands on the daily, so it hasn't actually, as far as I can see, particularly just here, really closed above the Bollinger Bands. This can keep on going. There's a lot of momentum now in gold. Obviously, too late, probably to join this party. But gold seems to be strong. US dollar, worrying about inflation, geopolitical risk, central banks buying it. Why not? Yeah. So just finally, guys, just before I let you go, I just want to have a look at some of the bonds. What's been interesting is that we did see a little bit of strength in the front of the curve in the US, just in the last little period. Not a huge amount. Hold on, let me just clean this up. White page. There we go. Okay, so what we can see here is the front end of the curve pushing a little bit higher. And that's mainly just on the sense of maybe a slowdown in growth, some idea that the tariffs could slow down growth. I don't know. The economic data to me still seems quite strong, and we didn't really see a huge repricing of the Fed. So I'm not sure how much we can read into this at the moment. Let's see what happens with the QRA. And we have to start looking at the data, because as long as the data remains strong, you've got to say that the chances of the Fed cutting is in the next month, next meeting or two is pretty minimal. So I think at the moment, really, what's driving this is the tariffs and the data rather than Fed policy, which, as far as I can see, is going to be on hold for probably the next two meetings at least. Okay, so that's it, guys. I'll let it go there. QRA at 8:30. We have at 8:15 ADP for the employment numbers, and then the ISM services. And of course, as always, I suppose we'll have to deal with Trump volatility. Okay, thank you. Have a great day. We'll keep on talking, no doubt. Thank you.